In Chapter 6, we'll be going through self-employed business income, which is reported on Schedule C. And this income and the deductions that relate to self-employed income on Schedule C affect the adjusted gross income because they're for AGI. So in this chapter we switch gears a little bit and talk about some fundamental accounting for pass-throughs. These are not C corporations, which are themselves taxable entities. Rather, these are pass-throughs such as would apply to a proprietorship or a partnership or an S-corp, certain LLCs. So, for our purposes, trade or business is any activity that is engaged in order to make money. One of the things we look at then is, first of all, we know the gross cost of goods sold, has the same connotation as it does in financial accounting. There are some special rules in the IRC that we need to follow, and one is that the accrual method of accounting has to be used if inventory is a material income producing factor, and then an example of this would be a manufacturer or a retailer. This has changed recently. If average annual gross receipts over the last 3 years is $25 million, the cash basis of accounting can be used for all other accounting. This $25 million threshold has increased. So the IRC, Internal Revenue Code, requires that for an expense to be recognized on Schedule C, the expense must be ordinary, necessary, and reasonable. And we look at ordinary to understand ordinary as expenses that are customary within your industry or trade or profession. Necessary expenses are helpful rather than essential. And reasonable expenses are expenses that are what someone would pay in an arm's length transaction. So, for example, if a person hired a relative to work for them and they paid them more than the market would normally pay them, then that would not be a reasonable amount. Certain kinds of expenses are not deductible since they result from illegal activities such as bribes, kickbacks. Lobbying and political expenses are not deductible, nor are fines and penalties. However, if you're on the receiving end of these cash flows, you are required to report these illegal activities as income. And again, these types of expenses are blind to the ordinary, necessary, and reasonable thresholds because they're illegal and they would never be deductible. A kind of accrued deduction is the depreciation, and in the tax code we use the modified accelerated cost recovery system or MACRS, and we have some typical depreciation periods. And so if a business has an auto, that will generally be depreciated over a 5-year period. Furniture, fixtures, and equipment over 7 years. Residential real property, such as the building, an apartment building, and that would be depreciated on a straight line basis over 27.5 years. And non-residential real property, such as a warehouse, would be depreciated over 39 years. And please bear in mind that the land that the buildings sit on is never depreciable. So there are some conventions that we use in the tax code. And the most common is a half-year convention. So it says, subject to certain limitations, anytime you purchase an asset in the middle of the year, such as a piece of equipment or a car for business purposes, whether it's in the beginning of the year or the end, we'll use the half-year convention. However, I said earlier that there are some exceptions to this, and one applies to the mid-quarter convention. The mid-quarter convention says that if you purchase more than 40% of your your fixed assets, in the fourth quarter of the year or the fourth quarter of the fiscal year, then the company is required to use the mid-quarter convention, and that is that no matter what quarter that asset is purchased in, it's assumed to be in the middle of the quarter. So, for example, if more than 40% of the assets is purchased in the last quarter, and you purchased an asset in the first quarter, then that asset would be the date of you'd begin to depreciate would be the middle of February. Year of disposal convention is the same, so if you use the half-year convention on the front end of the depreciation schedule, you would use the half-year convention on the year of sale or disposal. And the same is true with the mid-quarter or mid-month convention. By the way, the mid-month convention applies to real estate. So there is no accelerated depreciation for real estate. So if a warehouse is purchased in August, it's assumed that it's purchased in the middle of August. When we do accelerate depreciation for those assets that are 5-year, 7-year, and 10-year, for example, we use double declining balance or 200% of straight line. And then in some instances we use 150% or 1.5 times straight line. Or the taxpayer has the option of depreciating on a straight line basis. But if the taxpayer takes this straight line and approach, then they may not change back to acceleration. They must stay with straight line. And again, we're talking about equipment and furniture fixtures. What we're saying is we're looking at 3, 5, and 7-year properties primarily. Those are accelerated at 200%. Maximum IRC Section 179. This has gone up this year. A Section 179 expense means that if you purchase, for example, equipment, you're permitted to expense up to $510,000 of the cost of that last year. This year, that threshold has been raised to $1 million. So if you buy equipment worth $1 million, you can expense it immediately, subject to certain limitations. This Section 179 expense is really only designed for small businesses because it does phase out as income climbs. And the Section 179 expense cannot create a net operating loss. So if you have unused Section 179 expense available, you can carry it forward indefinitely. Well, another change in the 2017 Tax Cut and Jobs Act has been the increase of the 50% bonus to 100% bonus. So even subject to the 179 expense limitations, companies now can expense 100% using the 100% bonus. And that makes the Section 179 expensing far less important because of the limitations with Section 179. I mentioned earlier that MAKERS applies to assets with less than 20-year lives. So the acceleration takes place with those assets with a lifespan later less than that, less than 20 years. This deduction, if a person has income to offset against this 100% bonus deduction, it is fully deductible. And there are no other limits other than if you have to buy a luxury auto. As far as listed property, that's property that a small business owner may use for both business purposes and personal use. And this really relates not so much to direct expenses, but to indirect expenses. And there has to be a way of allocating some of these indirect expenses, such as real estate taxes. If a person's working out of their home, that's listed property, how much of that tax bill, the property tax bill, would be a deduction for business purposes on Schedule C, and how much would be an itemized deduction on Schedule A. And so we generally will calculate that by multiplying the property tax bill by the percentage of square footage that the home is used exclusively for business. You cannot use Section 179 on listed property if it's used less than 50% for business. So that takes Section 179 expensing on that asset. Straight line depreciation is required for listed property used less than 50% for the business. You can't use accelerated depreciation for, like I said, equipment that's used both for personal and business purposes if you use it less than 50% for business purposes. I mentioned earlier the luxury automobile limitations. So autos less than 6,000 pounds. Now this has gone up this year. Slight error in your text regarding this table. On page 6-17, those you should just insert year 1, year 2, year 3, and year 4. They have 2016, 17, 18, and 19 and succeeding, and that's incorrect. And so I would just replace first year, second, third, and fourth for those years. Again, this applies for luxury automobiles. These are autos less than 6,000 pounds. SUVs are treated a little bit differently. SUVs are the greater of 6,000 pounds. If they're greater than 6,000 pounds, Section 179 is limited to 25,000. So that's a special provision for sports utility vehicles that are greater than 6,000 pounds. You can use Section 179, but only up to $25,000. Another kind of business expense is transportation and travel. These have to be, again, ordinary necessary expenses. They are deductible. Generally, travel involves a stay overnight that relates to the business trip. That's different than commuting. Commuting is driving, for example, from one workplace to another. In some cases, there may be a deduction there. An employee can never take a deduction for commuting costs that are from the home to work. That's not deductible. But that's what we mean by commuting. Travel is different. Travel is where you are going on a trip and it requires an overnight stay. Then the cost of the lodging is a deductible expense. The transportation, which relates to the commuting I mentioned earlier, are expenses of getting from one workplace to another workplace within the home area. So that commuting or transportation cost is, again, relates only to traveling between workplaces within the general home area. The commute from your home to your job is not deductible. This year, the standard mileage rate is 54.5 cents per mile. The business has an option of using that standard rate, and that captures depreciation and maintenance and wear, fuel. If you want to track, if a business wants to track actual expenses, you can use the actual business auto costs, but you have to track that and be able to document it. Travel costs for business travel requires an overnight stay, I mentioned earlier. These travel costs should not last more than 1 year. If, however, the trip is for a partial personal or a partial and business trip, there are limitations that apply, but the trip may be partially deductible. Unless the expenses are over the top and they're just extravagant, then the IRS won't reward us for that, and they will only be allowed the ordinary and customary charges for those trip expenses. Meals, we generally can deduct transportation and travel related meals. They have to be directly related or associated with the business. Entertainment expenses used to be 50% deductible as well. They are no longer allowed, so no entertainment expenses associated with transportation or travel are deductible. And the standard meal per diem is $51 per day for meals. However, if you happen to be traveling to a high-cost area such as New York City or Miami or San Diego, the IRS publishes per diem rates that are higher for those more costly areas. In terms of business use for home and business bad debts, home office deductions are reported on Form 8829, so you have to kind of list those listed expenses, those home office expenses. I mentioned earlier, oftentimes those costs are allocated based on square footage, and there are two types of expenses, indirect and direct, I mentioned earlier. Direct expenses are fully deductible, so if you are operating a business out of your home and you incur expenses for that business that directly relate to the business and not to any personal use, then they're 100% deductible. Indirect costs, such as insurance on the building, property taxes we mentioned before, those are deductible and they're based on the square footage. So if the office that you're running your business out of in your home occupies 20% of the square footage of the home, then 20% of these indirect costs or expenses would be deductible on Schedule C. And we would report them on 8829 before transferring them to C. There's an order in which businesses must take deductions, and the reason that's the case is if we deduct expenses and they exceed our income from our business, then certain kinds of expenses are not deductible past zero. In other words, past the point at which we start losing money and creating a net operating loss. Expenses that are deductible in any event, though, are mortgage, interest, and real property taxes. Depreciation is always last. So we will only take as much depreciation on our home business assets as to the point where we have zero net income. And no greater than that, no more than that. In other words, depreciation cannot cause a loss. As far as bad debts are concerned, business bad debts can be deducted as an ordinary expense. It's part of the cost of doing business. We always want to differentiate between business bad debts and personal bad debts. So personal bad debts then would be a capital loss, and we have to apply that to our capital gains, and then we'd get $3,000 at most to take on capital losses per year. Business bad debts, however, you can deduct all of it. There are no limitations. In terms of casualty loss, this is a little bit different. If a tornado comes through and the insurance coverage doesn't cover all our costs and we suffer a casualty loss, then we receive an ordinary loss. And this ordinary loss is not limited by the 10% AGI floor like personal casualty losses. So with a business loss, it's 100% deductible. Casualty loss, business bad debts, 100% deductible. If it were a personal casualty loss, like a tree fell on our car and our car was not used for business purposes, then we'd be subject to deducting on Schedule A $100 netted out of the loss, and then after that only the amount greater than 10% of AGI. So I'll give you an example. If a tree falls on the car, it's uninsured, personal use auto only, not business, and we lose $5,000, then we deduct $100 from that to get to $4,900, and then we take 10% of our AGI, and if our AGI happened to be, let's say our AGI was 40,000, 10% of 40,000 is 4,000. So we would take the 4,900 I mentioned earlier, 5,000 minus that 100, and then we would deduct the 4,000 10% AGI floor, and only $900 of that damage on the personal use auto would be deductible as a Schedule A itemized deduction. Again, for businesses, however, we don't have to worry about those AGI floor limitations because business losses and expenses are fully deductible. If one is self-employed, they are responsible for paying both halves of Social Security, which is 6.2% for the employee, 6.2% for the employer portion. So they pay a total of 12.4%, Medicare 1.45% for each employee and employer portion, and then the total is 15.3%. They are allowed to deduct half of that. The employer portion they can deduct as a business expense. Social Security threshold limit has been raised to $128,400. So any income greater than $128,400 is no longer subject to Social Security tax. There is no upper threshold limit on Medicare. One of the last things I mentioned, a very new and somewhat complex provision for small businesses, is that they get to deduct up to 20% of qualified business income. And then they have some, they have some qualifiers here. This deduction is a lesser of 20% of the qualified business income or 20% of taxable income, netting out the capital gains. If the taxpayers are above the threshold income limit, which is $115,000 for married, $157,500 for all others, taxpayer subject to additional W-2 wage limitations. So this is a rather complex new provision that's afforded to small businesses to kind of equalize and give them the kind of tax break that corporations got because the C corporations received a large tax rate reduction from 35% to 21%. This provision is for small businesses and is designed to kind of equal the scales and allow small businesses to enjoy a greater reduction of taxes. So calculating these deductions, you can review the text, review some of the examples, but you will not be held responsible for the calculation of these, the limitations on the QBI deduction. But it's just good to be aware of them. If you have any questions on these or any of the concepts covered in Chapter 6, please let me know.